Welcome to the show. It is great to have you with us. Central banks are mounting a coronavirus rescue. Today, the Bank of Canada cut rates by 50 basis points on the heels of the U.S. Fed cut yesterday. I talked with TD's chief economist, Beata Caranci, about whether looser monetary conditions will keep the economy from diving deeper into a contraction that people are worried is coming.
Well, the good is I think that we're seeing a coordinated response, and we had a G7, almost an emergency meeting between finance ministers and central bankers on Tuesday. Out of that meeting, we're now seeing action. And so it does look like it's coordinated. We had Australia cut earlier in the week. We have expectations that the Bank of England will cut. So that's the good in terms of responsiveness, swiftness, decisiveness. The bad is it's a signal that the central banks and the governments feel that the COVID impacts are probably going to last a little longer than many had anticipated. Otherwise, you would wait it out. And so there's an element here where they're acting to shore up confidence, do preventative or preemptive cuts to be ready in the event that we have economic disruptions lasting longer than expected. And by longer than expected, I'd say like instead of a 1 month impact, this turns into 2, 3, 4 month impact of disruptions.
What about the concern of spooking people, perhaps, who weren't scared to begin with? And also, I think in Canada, you have a rate cut. I mean, we already have very low rates. We have a very strong real estate market. I mean, what are the follow-ons in those areas?
Yeah, so the way the Bank of Canada would think of it, you have to think of it from like, what is your risk factors that you're looking at today? So growth at risk. If you believe that this is not a very short-term impact, and meaning a matter of weeks, and in fact China was a good case study that it wasn't a matter of weeks, then you have to think about how far away are you from your target state in 3 to 6 months, because you're getting disruptions today. And so that's how they're probably thinking. And in the meantime, you trade off your near-term risks to the housing side. Because if household confidence falls, that no longer becomes an issue because people are not going to be out there buying houses no matter what the level of interest rate is. So the first order is shore up credit, liquidity, and confidence.
Okay. You put out a report just when we started seeing the initial impacts of COVID-19. And you've got to look here at what it means for the world economy, the U.S. economy, and the Canadian economy. Let's go to the world economy. We've got a chart we're going to bring up here, and it shows your baseline. We can see in the screen, and then it dips down and comes back up, and then it gets back down. But you're calling for about a 2.5% annualized contraction in China. That's unprecedented.
A contraction in China is unprecedented.
Yes.
So at that point, once you put a negative in front of the number, everything else doesn't matter at that point. So yes, they have never recorded that in modern history, and we are getting indications that that's the right call to make. So for example, they have a manufacturing survey that the levels fell lower in February than they did during the financial crisis. We had a report out today about auto sales having contracted over 80% in China. No surprise in the sense that they've been quarantining people, they've been shutting down businesses. So there is going to be this contraction coming through. The magnitude is not as important at this stage. What matters is that recovery cycle. And what we are getting out of China is some early indications that they are normalizing operations. And that should be of some comfort to what central bankers and governments are dealing with in North America and Europe, that their measures that they're taking are allowing them to start to reboot this production cycle. And so while you had this big drop in auto sales, it was a big split between what happened in the first half of the month versus the latter half, which tells me that confidence must still be there for people the minute that the weight is lifted, they're coming back out.
That is reassuring. You talk about the U.S. economy as well, and the phrase I think you use in the report is it's the steady eddy of the world. But one thing that you highlight, and we're going to bring up the chart here, and we're showing a worst case scenario. Actually, we're putting up on the screen right now. But you talk about the fact that if it's a 1 quarter slowdown, you see companies perhaps resisting layoffs. If it's 3 quarters, you may not be able to, and that's the crux of all this.
This is it. So, again, this is similar to what we were observing in China, what we're hearing in Korea and Hong Kong and Italy, that when you're in these temporary quarantine, blocked off zones, the incentives are, both government incentives and the central bank, is to encourage firms to maintain staff. It's very expensive anyway to lay off and rehire, so this is in the interest of the business themselves. As the shock extends, just financially, this is going to be a very difficult model. So in that downturn, that worst case scenario, that was a 3-quarter scenario, and that is a length of time that we believe would be untenable to maintain staff at that level, at constant levels. that means you get the layoffs coming through and the unemployment rates. And that was where you get a formal global recession that is more than just a supply side shock. You now have a demand side shock coupled with it.
Yeah, but that's not your base case right now.
No, and we're not seeing evidence of it. And if anything, China's giving us a little bit of encouragement, but we're very much in the eye of the storm. We're still waiting to see how this forms. So we just have to be fleet of foot at this stage with the forecast.
Which you are. We've been getting them updated. I want to talk about Canada for obviously our audience. And you talk about this is, we'll bring up the worst case scenario on the screen for people to see as well. But you talk about a much thinner growth cushion.
That's right.
Here in Canada. So what do you see here?
Yeah, and in fact, the Bank of Canada references or alludes to this in their statement today when they cut. So when you look at our growth profile in Canada, the last 5 quarters, we've only had 1 quarter where it's been meaningfully above 1%. And so we have this stagnant GDP per capita profile happening. In the first quarter of this year, we're only expecting 1% or slightly less. And so therefore, unlike the US that has that 2% cushion, so if you have a near-term shock that takes 1 percentage point out, you're still in growth phase. We just don't have that cushion. And then on top of that, we have a high household debt levels. And so the Bank of Canada would be concerned, and this is why, just because you have high household debt levels, that doesn't mean you shouldn't be cut, because you have to protect those households and their ability to pay. So pushing down the prime rate is actually going to be helpful for those who have debt related to the prime if they end up with job interruptions, especially those who are hourly wage workers who may be feeling it first before salaried workers.
Let me ask you, I've only got about 30 seconds, but fiscal stimulus, often people are pointing to say that's where it should be coming with.
That's
and
right.
We've seen it, you talk about it in China, Hong Kong, Italy, Korea, Canada. Do you think we're going to see anything?
I believe so. I think, we've already heard our Prime Minister Trudeau out speaking yesterday after the G7 meeting saying that their intent is to lean into this and help with targeted measures. We have precedents in Canada. You see it when you have natural disasters. There's targeted focused measures. The global landscape, the benefit of Canada and the US is they're able to observe what's happening in China and Europe and Asia in general before we have any dislocation happening in North America. And what you do see there are really smart, creative solutions of how to support businesses and households in targeted areas. Temporary measures, tax holidays for the period of time, ways to ease payments of debt while they're going through income interruptions. So I think Canada will mirror many of those initiatives.
Thank you.
My pleasure.